shares. The capital of a company is divided into small units called shares. The capital obtained by issue of shares is known as share capital. Each share has its nominal value. The person holding the share is known as shareholder. There are two types of shares normally issued by a company. They are equity shares and preference shares. The money raised by issue of equity shares is called equity share capital, while the money raised by issue of preference shares is called preference share capital. Equity shares. They are the most important source of raising long-term capital by a company. The capital raised by issue of such shares is known as ownership capital or owners' funds. Equity shareholders, also called residual owners, do not get a fixed dividend but are paid on the basis of earnings by the company. They enjoy the reward as well as bear the risk of ownership. Their liability is limited to the extent of capital contributed by them in the company. Through their right to vote, these shareholders have a right to participate in the management of the company. The important merits of raising funds through issuing equity shares are as follows. Equity shares are suitable for investors who are willing to assume risk for higher returns. Payment of dividend to equity shareholders is not compulsory. Therefore, there is no burden on the company in this respect. Equity capital serves as permanent capital as it has to be repaid only at the time of liquidation of a company. As it stands last in the list of claims, it provides a cushion for creditors in the event of winding up of a company. Equity capital provides credit worthiness to the company and confidence to prospective loan providers. Funds can be raised through equity issue without creating any charge on the assets of the company. The assets of a company are therefore free to be mortgaged for the purpose of borrowings if the need be. Democratic control over management of the company is assured due to voting rights of equity shareholders. The major limitations of raising funds through issue of equity shares are as follows. Investors who want steady income may not prefer equity shares as equity shares get fluctuating returns. The cost of equity shares is generally more as compared to the cost of raising funds through other sources. Issue of additional equity shares dilutes the voting power and earnings of existing equity shareholders. More formalities and procedural delays are involved while raising funds through issue of equity shares. The capital raised by issue of preference shares is called preference share capital. Preference shareholders enjoy a preferential position over equity shareholders in two ways: receiving a fixed rate of dividend out of the net profits of the company before any dividend is declared for equity shareholders, and receiving their capital after the claims of the company's creditors have been settled at the time of liquidation. In other words, as compared to equity shareholders, preference shareholders have a preferential claim over dividend and repayment of capital. Preference shares resemble debentures as they bear fixed rate of return. Also, as the dividend is payable only at the discretion of the directors and only out of profit after tax, to that extent these resemble equity shares. Thus, preference shares have some characteristics of both equity shares and debentures. Preference shareholders generally do not enjoy any voting rights. Types of preference shares. A company can issue different types of preference shares such as cumulative and non-cumulative, participating and non-participating, convertible and non-convertible, cumulative and non-cumulative preference shares. Preference shares which enjoy the right to accumulate unpaid dividends in the future years in case the same is not paid during a year are known as cumulative preference shares. On the other hand, on non-cumulative shares, dividend is not accumulated if it is not paid in a particular year. Participating and non-participating preference shares. Preference shares which have a right to participate in the further surplus of a company after dividend at a certain rate has been paid out on equity shares are called participating preference shares. Non-participating preference shares are those which do not enjoy such rights of participation in the profits of the company. Convertible and non-convertible. Preference shares that can be converted into equity shares within a specified period of time are known as convertible preference shares. On the other hand, non-convertible shares are such that cannot be converted into equity shares. The merits of preference shares are: preference shares provide reasonably steady income in the form of fixed rate of return and safety of investment. Preference shares are useful for those investors who want fixed rate of return and comparatively low risk. It does not affect the control of equity shareholders over the management, as preference shareholders don't have voting rights. Payment of fixed rate of dividend to preference shares may enable a company to declare higher rates of dividend for equity shareholders in good times. Preference shareholders have a preferential right of repayment over equity shareholders in the event of liquidation of a company. Preference capital does not create any sort of charge against the assets of a company. The major limitations of preference shares as source of business finance are: preference shares are not suitable for those investors who are willing to take risk and are interested in higher returns. Preference capital dilutes the claims of equity shareholders over assets of the company. The rate of dividend on preference shares is generally higher than the rate of interest on debentures. As the dividend on these shares is to be paid only when the company earns profit, there is no assured return for the investors. Thus, these shares may not be very attractive to the investors. The dividend paid is not deductible from profits as expense. Thus, there is no tax saving as in the case of interest on loans. To summarize, shares are the small units in which the capital of a company is divided. The capital obtained by issue of shares is known as share capital. The two types of shares normally issued by a company are equity shares and preference shares. The money raised by issue of equity shares is called equity share capital, while the money raised by issue of preference shares is called preference share capital.